What's going on? Alex here, and today I'm answering your tax questions from Reddit. And today's question has to do with the QBI, or the Qualified Business Income Deduction. Let's take a look. All right, so this question comes from Jayala and goes as follows. So I provide HR consulting services as a self-employed individual. If my Schedule C is showing $35,000 profit, is that eligible for the QBI deduction? My gross income was under $55,000. Naturally, I have Googled it and it's giving me conflicting answers, or at least it's not clear cut. Please help. And this is quite the poignant question because we get a lot of questions in our tax practice about the QBI deductions from clients because they see that the deduction is on their tax return in one year, but they don't see it in the following year. So there's a lot of questions in terms of why is it not consistent? Why don't we get it in one year versus the other? So we're going to take a look at the dynamics of how that all comes together and get a 30,000-foot understanding of what this is all about. And it's not surprising that this person Googled it and they received conflicting answers or unclear answers, and you're going to see why in a second. So let's back up a bit. The QBI deduction came about as part of the Tax Cuts and Jobs Act. Now, that was effective essentially as of tax year 2018, and the idea was that they were bringing the corporate tax rate down to 21%. And given that they were giving a tax cut to the corporations, all the other taxpayers go, hey, what about me? And every time there's a tax provision that benefits one area of the population, then the other area is usually crying about things being unfair. So Congress decided to even the playing field and say, hey, if you don't have a corporation, you could still benefit through this QBI deduction, which applies to essentially a good portion of taxpayers that are not C corporations, okay? And the way that's put together is fairly convoluted because the Tax Cuts and Jobs Act was a voluminous piece of legislation, to say the least. Now, you can see here, this is the code section 199 Cap A for qualified business income deduction. And you can see here that there's plenty of goodness over here. And those are just the actual provisions. Now, if you look at the regulations, you'll see 199 Cap A. There's plenty of stuff here that if you're ever having trouble falling asleep, pull up 199 Cap A, you'll be out in no time. It's hundreds of pages of legislation. And we're going to try to break it down for you here as much as possible to simplify this and get an understanding of what we're talking about. So thankfully, even though the regulations and the actual law itself is endless, the IRS was kind enough to provide some frequently asked questions that will help us kind of navigate all of this. And you can see here it's Tax Cuts and Jobs Act, Qualified Business Income Deduction, frequently asked questions. So let's get a bit of an understanding as to what we're even talking about here, and then we'll dive into the particulars and take this apart at a more minute level. All right, so it says here, what is the Qualified Business Income Deduction? It's also referred to as the QBID. And we see here that Section 199 Cap A, which is the provision of the Internal Revenue Code in which the QBI deduction is specified, it provides many owners of sole proprietorships. So what does that mean? That's if you are running under a Schedule C, if you're an independent contractor, if you have a DBA with no business entity, or you're a single member LLC, typically you're a sole proprietor, okay? So those are the types of taxpayers that fall into that category. Then you have partnerships and S corporations and some estates and trusts. And for all these taxpayers, it's a deduction of income from a qualified trade or business. All right. Notice C corporations were left out. So pretty much every business entity that you can think of aside from C corporations, that's where the QBID applies. The QBI deduction does not apply to C corporations. Why? Because they already received the 21% tax rate as a reduced rate. So the deduction has two components. Let's take a look. This is the QBI component, qualified business income. And this is the component of the deduction that equals 20% of QBI. All right, we don't have to get too complex here. Basically, if your qualified business income is $100,000, then the qualified business income deduction before anything else is 20% as a starting point. Okay, it's not going to end up there necessarily, but that's where it begins. And that's what this 20% is specifying. So this is the 20% of business income from a domestic business. That's important. All right. So has to be here in the United States, operated as a sole proprietorship or through a partnership, S corp, trust, or estate. Depending on the taxpayer's taxable income, that's another key note. The QBI component is subject to multiple limitations, which we're going to look at, including the type of trade or business. Also, the amount of W-2 wages can come into play. We'll take a look at this. And the unadjusted basis immediately after acquisition. All right, this is also known as UBIA. You can see how technical this is starting to get, but we're going to try to simplify it as much as possible. And this is the unadjusted basis of property held by the trade or business. And income earned through a C corporation, as we already discussed, or by providing services as an employee, is not eligible for this deduction. All right, so if you receive W-2 wages from a third-party business, that does not qualify you for any sort of QBI deduction. And even if you're an S corp owner and you receive wages from your S corp, those wages are not QBI. They're not qualified business income. So you also have a REIT component. REIT stands for Real Estate Investment Trust. And it says here, this component of the deduction equals 20% of the combined qualified REIT dividends. Don't worry about that. But it basically is based on the amounts that you get out of investing in a real estate investment trust as the investor. This component is not limited by W-2 wages or UBIA of qualified property. So basically, you can have the QBI deduction, and you can also have the QBI based on your REIT income. They're not calculated together. They're basically separate items. You can have some of this one and some of this one. That's what it's basically noting here. All right. And even if you're limited, we'll look at some of the limitations. Even if you're limited in terms of the QBI deduction, you may still be able to benefit from the REIT component. All right. Now we know that there are two basic components to the QBI deduction. Let's keep on going. And it says here, who may benefit from the QBIT? And we already covered a lot of this. So individuals and some estates and trusts with qualified business income, qualified REIT dividends. As I mentioned, investors in REITs get this benefit as well, or qualified publicly traded partnership income. All right, so far so good. How do S corporations and partnerships handle the deduction? Because if you guys are seasoned viewers of this channel, you know that those are pass-through entities. They typically don't pay tax at the entity level. That means S corps and the partnerships. They will flow through the income and deductions down to their partners and or shareholders. And we see here that S corporations and partnerships are generally not taxable and cannot take the deductions themselves. Makes sense? However, all S corporations and partnerships report each shareholder or partner's share of QBI items, W-2 wages, UBIA, all of that good stuff on Schedule K1. So whereas you might be an investor in 5 different partnerships, you will get K1s from those partnerships that will specify all of this QBI information for your tax preparer to take it into account on your personal return. So while the information comes from the entities themselves don't take the QBI deduction. You take it as an individual. All right, so it has to all filter down through the K1, either from the S corporation and or from the partnership. Okay, so what is qualified business income, right? So we have the deduction. What actually qualifies as income in the first place, on which the 20% is calculated? Let's take a look. So QBI is the net amount of qualified items of income, gain, deduction, or loss from any qualified trade or business. Only items included in taxable income are counted, which is important. So if you have a bunch of tax-exempt income, that's not going to help your QBI deduction. In addition, these items must be effectively connected with a U.S. trade or business. Now, there are a lot of questions as far as what does effectively connected mean. You can do your own research on that, but that's an important point. This was meant to benefit domestic businesses, not foreign businesses. Items such as capital gains and losses, certain dividends, qualified dividends, and interest income are excluded. And W-2 income, as we already mentioned, amounts received as reasonable compensation from an S corporation, and note, amounts received as guaranteed payments from a partnership are not QBI. All right. So let's reiterate. W-2 income, not QBI. If you receive guaranteed payments from a partnership, you'll see on that K1 line, guaranteed payments. If that's what you receive, that's also not QBI. And if you are an S-Corp shareholder and you get wages from that S-Corp, you might say, hey, I got $300,000 in wages. Great. Well, that $300,000 by itself is not QBI. All right. And as we're going through this, guys, if you are getting some insight into the QBI deduction that you didn't have before, smash that like button, would you? I see some of you are watching. You haven't hit the like button yet. Appreciate it if you would give that a shot. Helps the channel. So now that we know what QBI is, we talked about the QBI deduction. What is a qualified trade or business? All right, so let's take a look. A qualified trade or business is any Section 162 trade or business. Don't worry about the technicalities of that. It's just your plain Jane vanilla business. With 3 exceptions. 1, a trade or business conducted by a C corporation. Again, this was meant to benefit businesses other than C corporations. Makes sense? Then we have the trade or business of performing services as an employee. We talked about W-2 wages don't count. But here's a key point that we're going to discuss right now. For taxpayers with taxable income that exceeds the threshold amount, we'll go over that. Specified service trades or businesses are basically limited over certain income amounts in terms of taking the qualified business income deduction. So you don't want to be generally an SSTB for QBI purposes. All right. So specified service, trade, or business means that your QBI at some point may be limited. All right. So that's not an attractive position generally from a QBI perspective. All right. An SSTB is a trade or business involving the performance of services in the fields of, all right. So this is field specific: health, law, accounting, actuarial science, performing arts, consulting. And you can see the list here. There were very particular aspects of work that were chosen to be specified as specified service, trade, or businesses. All right. So if your business falls into one or more of these categories, then you basically have to operate within the scope of the QBI deduction as a specified service, trade, or business. It's something where you either are or you are not. And sometimes it's a little complicated to determine which businesses are SSTBs, because let's say you have an optometrist and they provide optometrist services in the back of the store, but in the front of the store, they are selling glasses. So are you in the service business or are you in the retail business? Okay. It turns out that there's a bit of analysis that needs to be done. And sometimes there's some planning here that can be done to structure a business in a way that you may be able to avoid some of these SSTB implications. But to put it in very short terms, you don't generally want to be SSTB for QBI purposes, but sometimes it pretty much is what it is, and you just have to go with it. All right, so now we know that there's this QBI deduction. We talked about what our businesses are eligible for. They're qualified trades or businesses. Then we talked about what QBI actually is, the type of income that is and isn't eligible. And we're just scratching the surface here, guys. As I mentioned, this is hundreds of pages that I'm trying to distill for you guys in very simple terms, all right? So bear with me. Now, if we take a look here, we know that if the business is an SSTB over certain income thresholds, then your deduction is going to be limited. We'll take a look at that. But what if you're not an SSTB? Is your deduction still limited? If your business doesn't fall into one of these categories that we talked about, if you're not in these generally service businesses, but not necessarily. So if you're not an accountant, actuarial, science, if you're not in performing arts or consulting, do you have to worry about this income threshold? Well, it turns out you do. And it asks here, I report taxable income over the threshold and in the phase and range. We'll cover that, don't worry. However, my income is not from an SSTB. Am I entitled to the deduction? And it says you may be able to take the QBI deduction, but you have to factor the amount of W-2 wages paid by the qualified trade or business and the UBIA, we already talked about that, the unadjusted basis of assets held by the trade or business. So now you have these 2 additional parameters to take into account, believe it or not, before you can determine whether you qualify for the QBI deduction, and if so, to what extent. Don't worry, I'm going to break this down. But you can see here that there's quite a bit that goes along with the QBI deduction and figuring out whether you're eligible. Now, the funny thing is that there were a bunch of businesses out there that tried to simplify this. So you can see here they have the simple flow chart of the QBI deduction. And here's what that simple flow chart looks like. Now, you tell me, guys, in the comments, does this look simple to you? And you can see here that it asks, do you have income from a pass-through entity? And if no, then you don't qualify, right? C corporations would be a non-pass-through entity. So you would end your journey here. And if it is a pass-through, then yes, what is your tax filing status, and so on and so forth. You could see that it pretty much branches out in all these different directions. There's actually a different flowchart that I found online here. This is by Wagner, Ferber, Wine, and Ackerman. Never heard of them before. I'm sure they're great. And you can see here that there's a similar flowchart. I kind of like the flow of this one a little bit better. So let's take a look and see if we can demystify this crazy deduction. Now, determining your deduction on pass-through income. Now, this is from a prior tax year. I believe this is from 2018. So these numbers are going to be a little off. We'll look at the new numbers. But in general, it helps us to conceptualize all of this craziness and understand why sometimes it may be applicable, other times it may not. It's a little bit involved, all right? So, is your total taxable income lower than the threshold, between the upper and lower threshold, and income is above threshold? What is this referring to? Well, it's talking about these thresholds up here, all right? And these are adjusted on an annual basis. And over here in Revenue Procedure 2021-45, we see the current amounts for 2022, all right? So you see here for taxable years beginning in 2022, the threshold amounts are as follows. So you can see here, it depends on filing status, but if we look at all other returns, which would include single filing status, we see that the threshold amount is $170,050, and the phase and range amount is $220,050 for 2022. And what that means is basically as taxable income, we'll see how that's calculated in a second, goes above $170,050, then your QBI deduction may start to phase out, all right? And that phase out is going to continue until your taxable income is basically $220,050. Now, as it gets to that point, your QBI deduction has phased out, and above that point, then you have to go through a few hoops to determine what your QBI deduction is. But in very general terms, when we look at this flowchart here, when it's talking about the lower threshold and upper threshold, you're basically looking at these amounts. But for 2022, these are the amounts that are applicable. For that prior tax year, they were different. All right. So let's take a look at this. So if your taxable income is lower than the lower threshold, then your QBI deduction is 20% of your QBI. We talked about that, all right? So you get the full deduction if you're under the threshold amount. So if your taxable income in 2022 is under $170,050, you're all set. You get the full QBI deduction, and we'll take a look at a tax return in a little bit to show you how this works. Now, what if you're between those two amounts, right? We talked about something like a phase out comes into play, right? So you don't get the full amount, but you don't get absolutely nothing. You get somewhere in the middle, all right? And as your income increases, your QBI deduction will start to drop. Okay, so if your income is above the threshold, this is where it gets kind of interesting, all right? Now we start branching out. And we talked about the SSTB designation, right? Specified service, trade, or business coming into play. Well, here's where it comes into play. If your income is above the threshold now you have to ask, are you a specified service, trade, or business? And if you are, then you don't get the QBI deduction. As we talked, it phase out, right? So if your income is above the threshold and you're an SSTB, you're done. Okay, so you don't have to deal with this chart anymore, but on the downside, you missed out on this deduction. And there's a bit of social engineering at play here, right? If you're thinking these are SSTBs are generally service business, they're generally high income businesses, as we talked about. So in that case, you can kind of get an idea of where Congress was going here. But nobody's perfect, right? So it may not accomplish what they set out to do in many cases. Now, let's go back to the chart. Are you an SSTB? Your income is above the threshold. And if you are not, the question is your QBI limited? Well, then the question is, do you pay wages or own qualified assets? As we talked about, the question of whether there are W-2 wages comes into play, and the UBIA, or the unadjusted basis of assets immediately after acquisition, that comes into play as well. So here we have to start asking those questions. Now, if your income is above the threshold, you are not a specified service trade or business. The question is, do you have wages or qualified assets? And if you don't, then you don't get the QBI deduction, all right? You're in the red over here because you're not eligible for it, unfortunately. Now, if you do pay wages or own qualified assets, you go here, yes, which is higher? 50% of the wages your company paid, or wages your company paid plus 2.5% of your company's qualified assets. Now, if you're watching this right now and going, this is absolutely nuts, the response I have for you is, these are your tax dollars at work, okay? This is Congress, and here's what they spend their time coming up with. I think it's kind of crazy, right? But it is what it is, right? And if you think it's crazy, smash that like button, would you? All right, so coming back to this chart here, we ask which is higher. So 50% of the wages your company paid, or 25% of the wages your company paid plus 2.5% of your company's qualified assets. Now, whichever is higher is your maximum allowable deduction. And then we have to go over here. So does it exceed 20% of your QBI? You still have to go through this comparison process. And if no, your deduction is equal to your maximum allowable deduction. And if yes, your deduction is equal to 20% of your AGI, okay? So the question is, do you get to deduct this amount that we calculated here, or are you limited by 20% of your QBI? It's the lesser of, okay? So you can see here that it's a little bit crazy, and you can see that obviously there's a lot that goes into determining whether even a business qualifies for the QBI. And even though the amounts change here for the thresholds from year to year, this flowchart, I haven't spent hours vetting it, okay? But I can tell you in general, this is the decision tree that you need to go through to even determine whether a business qualifies for the QBI deduction or whether it's limited to some extent and so forth. This is why sometimes clients ask us quick questions, and we tell clients that quick questions never have quick answers, all right? So this gives you a bit of behind the scenes of what we go through trying to answer a quick question for a tax client. All right, so now that we've done all of that, gotten a good understanding, let's try to see how this works in the tax software, all right? And here we have a pretty much vanilla client setup, single filing status, nothing really going on except for the standard deduction. So let's see if we can make some of these numbers come to life, all right? So we have Schedule C set up, and we're gonna assume gross receipts of 100,000, all right? And we specify that this is a qualified trade or business. We're assuming this is not any type of foreign business, anything like that. And for now, we're not gonna specify that it's a specified service trade or business. So this is non-SSTB treatment. Okay, so let's see how this plays out. And we have 100,000 in net income on Schedule C. And if we look at the 8995, you can see here, this is where the business income deduction is calculated. And you can see here, they were nice enough to specify that this is the simplified computation. As you can see, this is all simple, right? Hey, how's that simplification of the tax code going for you guys? All right, let me know. Anyway, so you get this calculation here, and you might be saying, hey, wait a minute, Alex, this is not 100,000. Where's this 92,935 coming from? Well, you'll see here that the net income from Schedule C is actually 100,000, but what ends up on the 8995 is a little different. The reason being is that for qualified income deduction purposes, you can see here on the worksheet, you take the business income and you have to deduct the allocated deduction for 1/2 of self-employment tax. That's how we get the 92,935, okay? So don't let that throw you. The net income on Schedule C is not gonna agree generally to the 8995 income for QBI purposes, but that's generally the reason. There's some other adjustments, but that's why that's going to be different. All right, so let's see here on this 1040 if we get the QBI deduction, and we see here that we do. So 15,997, and that makes sense, right? Because we're a qualified trade or business. We have income that's under the threshold. Now, in this case, we're going to take a look at the 2022 thresholds, and we'll see that for single filing status, it starts to be limited at 170,050 of taxable income before the QBI deduction is taken into account. So here, if we were to calculate that, we would get the amount of adjusted gross income, so 92,935 minus the standard deduction, 12,950. So our taxable income is 79,985. We're under this threshold that is applicable for that tax year. So we should get the full QBI deduction. And as you can tell, looking at 8995, that is the case. So it's taking the 92,935, multiplying it by 0.2, which is 20%. And we can see here that taxable income before the deduction. And as we talked about, there's still some different parameters that come into play. So you may not get the full 20% of your actual qualified business income. Because take a look at what's happening here. The taxable income before qualified business income deduction is 79,985. And it's saying, wait a minute, what's lower? Is it 20% of the 92,935? All right, which is that 18,587 amount, or 20% of that 7,985 amount, all right, and it's coming out to 15,997, all right? So it's a lot of which one is the lower of and making sure that you take the right amount when all is said and done. So with that, we see the QBI deduction is the 15,997. We know how that's calculated. Now, let's go back and make a few adjustments here to the Schedule C. Now, first off, we want to now increase the income. All right, so before we change anything else, let's change the income to $300,000. All right, so this is net Schedule C income. And what do you guys think is going to happen? All right, leave a comment down below if you have some expectation in this regard. And looking through here, basically we have Schedule C, net income is $300,000, 8995. Now we have the 8995A. Now we're super fancy, okay? And you can see that now it looks a little bit different in terms of the reporting. So let's take a look at the 1040 and see what we have. We see here that the QBI deduction has disappeared, right? Why can that be? Well, we talked about the fact that the QBI deduction generally starts to get limited above certain thresholds, all right? And over here, we see that it's disappeared completely. And let's take a look at what our taxable income is before the QBI deduction. So in this case, it's 286,869 minus the standard deduction of 12,950. And our taxable income is essentially 273,919. And are we above the threshold? Let's see. So here, we're not only above the threshold amount, we're even above the phase-in amount, which is basically if you exceed that, you get zero deduction. All right. So let's take a look if we can actually model out what the partial deduction might look like. So if we can get the taxable income between 170 and 220, then we should see that partial QBI come into play. Let's see if we can model that out. Let's change this to 190. All right, let's see if that gets us there. And we can see here that we get the 33,078 in terms of the deduction. Let's see what our taxable income is. All right, so we take the AGI, 178,342 minus the 12,950. We get 165,392. Now, where are we in terms of, okay, so we're below the threshold amount. Let's add 20,000 in income, and let's see if this 33,078 decreases on us, all right? So 210, all right. And here, you can see that the QBI deduction now is lower, and it's basically the phase out kicking in, all right? So the amount of the QBI deduction starts to decrease, and if we take it all the way up to, let's say, the 300,000, then it'll phase out completely, all right? This is with a non-SSTB, all right? So now we can see how it works in the plain non-SSTB scenario. Let's try to change it up, and let's consider what an SSTB treatment might do for us, all right? So now we're just saying that, hey, this is a specified service trade or business, which is, again, not very desirable from a QBI perspective, all right? And let's change the income back to 100,000, and let's see what happens. All right, so in this case, we're below the threshold. We got the 15,997 in qualified business income. All right, we see it calculating here. So right now it's functioning exactly as if this business was not an SSTB because we're under the threshold, all right? When we first looked at this frequently asked questions document, it asked whether the business is a SSTB, right? So it's basically, it has three exceptions. And for SSTBs that exceed a certain taxable income threshold, then it starts to be ineligible for the QBI deduction. So we're below that, so it's not affecting us right now. But let's change this up a bit and let's see what happens if we start to exceed that threshold amount? We go back to 300,000. And then as you can see, the QBI deduction now went away again. All right. And if we look at the flow chart here that we were referencing, we could see how this all plays out. So let's take this scenario into account, right? So is your total taxable income, in this case, we're above the threshold, right? Because we're at 300,000 on Schedule C. Are you a service business? We're assuming yes, because we hit that SSTB button. And again, we don't get the QBI deduction. All right. So what if we get rid of that SSTB designation and add some wages now? So now we're trying to venture into this area of the flow chart. Okay. So now we are not an SSTB. Okay. And we still have above the income amount, right? So we're specifying that we're just a qualified trader business, not specified. And if we go back, we see that 300,000, there's still no QBI deduction, which makes sense. But if we look at the flow chart, we could see here that if it's not an SSTB, but you pay wages or own qualified assets, then you essentially get some QBI deduction. Let's see if we can replicate that without getting overly technical here. But at the end of the day, let's see if we can make it work. So if you paid wages or own qualified assets, so let's go to the Schedule C. All right. Now, as the business owner, this is you paying wages to your employees. Don't pay wages to yourself as a sole proprietor to try to get the QBI deduction. You're not supposed to do that. These are wages paid to other employees that you have for that business. So over here on Schedule C, let's add some wages. All right. And we'll say we paid, let's say 40,000. All right. Okay. Now, let's see if some QBI deduction comes into play here. All right. And if we take a look, now we have exactly 20,000 in QBI deduction. Let's see if we can get a worksheet on this. And we go back to Form 8995. Again, this is where all the QBI goodness takes place. And let's see if we can unpack what's happening here. We have the qualified business income from the trade or business, 247,404. Where did that come from? Well, if we look at Schedule C, we have 300,000 in income. We have 40,000 in wages. That's an expense. The net Schedule C income is 260,000. But as we talked about, there are a few adjustments that have to be done to get to that QBI amount, right? Qualified business income. So here we see that calculation happening, and you can see that the income is 260,000. That's from Schedule C. And then you get a deduction for 1/2 of self-employment tax minus the 12,596. You get to 247,404. Okay. So now we know where the 247,404 is coming from. Then we multiply it by 0.2. And again, with the QBI deduction, it's generally the lower of this, lower of that. But we multiply it by 0.2 to start with, then we get 49,481. But we know we're not done there. And then we see here allocable share of W-2 wages from the trader business. Here's where the 40,000 comes in to help us. All right. Then we multiply it by 50%. And then you can see here all these different calculations. But at the end of the day, you see here that the 20,000 is coming from basically being 50% of the 40,000 in wages. And at this point, let's go back to our flow chart. And you can see here that now we get 50% of your company wages paid. And then the higher of these two is where we are here. So now it's 20,000. And then the next question is, does this exceed 20% of your QBI? And if it's no, then you get that amount. And if it's yes, your deduction is still limited to 20% of your QBI, which we see was calculated all the way up here, right? So the question is, okay, what's lower? This amount that we calculate based on 20% of the qualified business income, or this amount? So that's why we're taking the lower of. And if we go to the Form 1040, we see here that it's resulting in a QBI deduction of 20,000, all right? So even with high income, if you're not a specified service trader business, there still may be some QBI deduction available for you. Now, trying to understand the logic of this is a separate question. That's beyond my pay grade. But I can tell you that there is a process that you have to go through to determine whether or not you qualify. And sometimes maybe there's some planning that can be done in terms of maximizing the QBI deduction, right? Because you can be sure that when this legislation came out, businesses were trying to do a bit of strategizing to see how they can move things around to increase their wages or increase the amount of the unadjusted basis of assets immediately after acquisition, the UBIA, so that even with high income, they're enjoying some of this benefit. All right. So hopefully this gives you some insight. Basically, we're running through all different iterations of this flow chart here, and it's extremely useful in trying to wrap your head around why you may be eligible in one year, but not the next, and all that good stuff. But let's go back to the question. We did start with a Reddit question at the beginning of all this, right? So I provide HR consulting services as a self-employed individual. Now, there are a few key terms that if you've been watching this video diligently, you know that some things are popping out there, right? So HR consulting services, all right? And what is that bringing to mind immediately? Well, hopefully specified service, trade, or business, all right? If we look back at this IRS frequently asked questions document, we see that is a trader, SSTB is a trade or business involved in the performance of services, bam, 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 consulting, all right? So now we know that this is an SSTB for QBI or qualified business income deduction purposes. And this person is also a self-employed individual, all right? So now it says QBI from a business operated as a sole proprietor, okay? So we know that we're meeting a lot of the requirement right there, okay? So this is not a C corporation. If my Schedule C is showing $35,000 profit, now I don't know. Oh, I see some questions coming in here, and I'm going to take a look at them in a second, all right? So keep your questions coming. I will take a look at those at the end, I promise. Now, if the Schedule C income is showing $35,000 in profit, which I don't know why that doesn't align to this subject of the question, $15,000, we're going to assume $35,000 is the right number. And I don't know what it is, but every time we ask clients, hey, what is that number in box 1 of Form W-2? They'll say a number. And then when we compare it to the W-2, it's never correct for some reason. I don't understand why. And more so, we can't even figure out where they got this number from. W-2 might say 120,000 in box 1, and they'll tell us 380,000. It just never ceases to amaze. Anyway, back to this. So my Schedule C is showing $35,000 profit. Is that eligible for the QBI deduction? My gross is under $55,000. So we're going to assume $55,000 on the dot. Let's model this out to see how this all can play out. So we first have to specify that it's a qualified trade or business and that it's a SSTB, because that just is what it is. Then we have to adjust the income. So let's say the gross is $55,000. All right. And then the expenses, let's just say, are going to be $20,000. So we get a net of 35. Let me make sure. Okay, let's take the wages out for a second. And we have net of 35. Let's just confirm. So on Schedule C, we have a sole proprietorship doing some business. We have 55,000 gross, 20,000 in expenses, giving us 35,000 net. All right. Now, if we take a look at the worksheet here, we'll see what amount we're using to calculate the QBI deduction. So Schedule C net income is $35,000 minus the half of the self-employment tax, which is $24.73. We're getting $32,527. Let's go to the 8995. We get $32,527. And first step is we take 20% of that. All right. And we get $65.05. Then we don't have any qualified REIT dividends in this example. So we're still at $65.05. And again, QBI is always comparing the lower of and making you take the lower of. Now, taxable income before qualified business income deduction is $19,577. Where's that coming from? Well, going back to the 1040, we remember that we have to take a look at the taxable income before QBI. So that is the AGI, so $32,527 minus the $12,950 gives us $19,577. All right. So if we go to the 8995, we get the $19,577. And we take 20% of that because it's the income limitation kicking in essentially. And that is $3,915. Okay, so now we take the lower of this amount here, $6,505, or 3915. And in this case, it's 3915. If we look at the 1040, that's what we have. Now, you scholars who are watching, if you've been paying attention, have we answered the question, or are we missing other information? All right. Is the end all be all that this person gets 3915 in qualified business income deduction? Are we finished? Hit me up in the comments. I want to see what you're talking about and what your thoughts are on all this. Now, in this case, we don't have enough information to answer this question. Okay. The reason being is we have no idea what this person's taxable income is. This is why it's dangerous to answer these quick questions off the cuff, because if we don't know anything else about this taxpayer and we're just going to go on assumption that this is this person's only income for the year for a second, we might say, yeah, this person qualifies for 3915. All right. And this is even taking into account that they're a specified service, trade, or business. But what if they also have wages? All right. And the person in the post didn't indicate any of this information, but what if they have 300,000 in wages and the schedule sees their side gig or their side hustle? Let's see what happens. Well, we see that the QBI deduction disappeared, right? And that's because the income is over the threshold, all right? Let's see if we can make our way through this flowchart to see why we all of a sudden lost the QBI deduction. So is your total taxable income, we're above the threshold. Are you a service, trade, or business? Yes. Boom. We're done. All right. Now, those of you who are really paying attention should be able to tell me, how can we get this taxpayer some QBI deduction? If they're saying, Alex, I really need some QBI deduction, what can we do? Well, we would need, well, in this case, we can't really do anything because it's a specified service, trade, or business. But if it wasn't, then we go into the question of wages, the qualified assets, UBIA, and making that determination from there. So in this case, unfortunately, given that it's above the threshold in this case, the QBI deduction is out of the question. But the important thing is we don't know until we get all of the information applicable to this person's tax situation and then assessing from there whether or not they qualify and to what extent. But just given this information here, we don't know if this person would qualify. So that's why it's dangerous to kind of answer tax questions where you don't have the whole story. So hopefully this adds some insight into this crazy tax provision known as the QBI, or qualified business income deduction. We get so many questions about it because honestly, it wasn't intuitive the way it was put together. So obviously when you have a taxpayer who in one tax year gets a huge QBI deduction and the very next tax year without too many changes in their business gets zero, they are curious as to why that's the case. They think something was missed or there's a mistake. But the way this is put together, the way the legislation was done, it's just not straightforward. It's really convoluted. All right. So I see that there are some questions here. All right. So we have Anthony putting down some good questions. Let's see if we can get some of this answered. All right. 1 second. Let me make sure we're not violating anybody's privacy over here. Okay. And let's see what we have. This is from Anthony. Appreciate you tuning into the stream. Glad to catch you on the live stream. Glad you're here. Just passed the EA exam number 2 today. Congratulations. Beautiful. Thanks for your videos and real-world application of the tax code. Well, I appreciate you saying my videos rock. I think you rock, Anthony. Thank you so much for tuning in and hanging out. If you enjoyed the video, if you're getting some value out of this, feel free to hit that like button, all right? Helps out the channel. Okay, so now, let's see. I was listening to the video lesson from Paskey, 50% of wages or 25% of wages plus 2.5% of depreciable assets. How they came up with that, I have no idea, but at the end of the day, I'm sure it accomplishes some social engineering goal one way or the other. And she was saying that accounts now try to make every chair and desk and put them on the balance sheet to classify them as assets to increase the qualified business income deduction. That's true. When this came out, certain business types were scrambling to figure out how they can generate wages and how they can get assets on the balance sheet, whereas they didn't have any before. So now, whereas we would advise clients prior to the QBI deduction to purchase assets to decrease their taxable income to try to take accelerated depreciation, things like that. In this case, now there's an additional benefit because now you're getting assets for purposes of UBIA for QBI purposes, all right? There's an additional potential benefit for a business if you can navigate your way through this crazy flowchart here and actually end up in a situation where you get a deduction and not in one of these red areas, okay? So again, thanks to Wagner, Ferber, Wine, and Ackerman. I'm sure they're great, but I just took this off their website and it's pretty concise in terms of making sense of all of this craziness. All right, so hopefully, guys, this adds some insight in all of this crazy legislation that came out. If you guys need help with the QBI deduction, if you're stuck on your tax return, we can help you get through it. We provide a full suite of accounting, bookkeeping, tax preparation, and planning services. So our contact information is in the description. Feel free to reach out. Now, as always, hopefully this was helpful. If you guys liked the video, share it, subscribe to the channel, hit that bell icon to be notified of future videos because there will be more. And hopefully, when all of this plays out, you guys will be a lot smarter for having tuned in. All right. And as always, hopefully this was helpful. Thanks for watching.